Hello and welcome. This is Jamario Walker. I will be going over some swing trading tips and tactics for you. Just some couple of strategies to help you find, swing trading opportunities in some of the most commonly traded assets. Today we're looking at Apple. This is a daily chart showing 3 months of the price action for Apple. This is August, September, October, and then we got the beginning of November. So what you're going to be looking for when you're swing trading is you want to look for opportunities where you can hold a trade over a day, maybe a week, maybe 2 weeks, maybe a month at a time, and profit off of that, off of that trade. It's best to look for opportunities in trend reversal areas where you're beginning to rise up from a flat state or from a down state, or you're beginning to rise down from an up state. And I'll show you that here. So let's see, this is July 30th, this is 31st, and this is August 1st. So we're gonna go ahead and get our ranges set here. Since it's not, you're not trading that open, you can't really utilize the initial bar range technique. But what you can do is utilize elephant bars as your initial bars. These elephant bars, they represent, massive selling, the start of big moves. They represent institutional traders jumping in and piling behind an asset, because they think it's going to go up or they think it's going to go down. It's one of the two. So you look for these signals to start your not day trading, to start your swing trading opportunities. So this particular one here is August 2nd in Apple. We've got a big bar. It took us above our 8-period moving average, the 13 and the 20, and we're well above the 200 already. So what you'll do is after that initial range, you want to look for a break above that range and follow through. So this is our first day, we get our range. The second day we break out of that range. The third day we get follow through. This is your point to go long on Apple. So here, what day is this? This is August 4th was the day for you to go long on Apple. And after putting that trade on, you set your stop on the bar you put the trade on. So this would be your stop bar here. You would stop out of that trade, what's that, at a 103.96. Anything under that, you're out of your trade, no questions asked. But we put on this trade because we're above all of the moving averages. We just had follow through from our breakout. So this is a good trade, good positioning, and it's a good symbol. Put on that trade, you would have profited all of this entire up move for pretty much the entirety of August. You don't want to get out of that trade until you start losing respect for your 8-period moving average, and that's not until here. On these pullback opportunities here, you could have added to your position, could have added to the position here. You touched the 8-period moving average, but you didn't go through it. Those are great, in a good uptrend, a stock will move up against the moving averages. It's just the nature of the market. It's the nature of the market participants. It's gonna happen. If it's a good asset in a strong trend, it'll bounce off, and those bounces will give you good opportunities, to add more to that position, and things like that. As far as taking profits, you take profits once you're away from your moving average, once you extend far away from it. I would advise you not to take it until you start losing respect for the moving average, like right here. But you can't, you can take profits at these points here, the top area here. Any of those locations will be good profit points. But you don't want to get out of the trade until you start losing respect for that moving average. That is a great trade for Apple. Then after that, after you lose that, this area here, this topping pattern here, and this bar becomes your next range you're going to use for your breakout opportunities. So after you close that trade there, you take your money, your profits, you do what you're going to do with it, you reinvest that amount, and you get ready for your next trade. You can actually just look for Apple here, and your next opportunity is coming right up. So you get that big drop. We dropped through the 8-period moving average. We touched the 13. So that becomes our new, let me get rid of this here. Okay. So this bar here is now our red range. So a break out of this bar will be our confirmation of a bear trade, or time to put on a bear trade. We get this confirmation here on, what day is that? That is September 4th. So September 4th, we get our confirmation. We go short here. So this is our shorting opportunity. We're now under the 8-period moving average. We closed under the 13, and now we've closed under the 20. So we're below all of our 3 main moving averages. We put on our bear trade, and you want to hold that trade until you lose respect for the 8-period moving average. We bump up here, but we don't lose respect for it. We bump here, but we don't lose respect. We don't lose respect. This push off would have been a great opportunity to add more, right in this bar here. And you want to hold that trade until we bumped again here, we bumped again here, we bumped here, and then we started to lose respect here. So this bottom area is where you want to get out of this trade. So we've done 2 trades in Apple, just following the price action and trading accordingly. One here, and we put on another trade here. Now, after this bottoming action here, what you're looking for in this bottom, let me go ahead and get some of this out of the way. So from this bottom, this is now our new range bar. We're going to look for a break above this range and follow through. We get the break above, and then we get the follow through. So this is our next trading opportunity in Apple. We're above the 8, we bust above the 13, and we're bumping into our 20. Now our goal now is to see, can we break out above the 20. So what I would do is go ahead and set this as another range, trading range bar. So a break above this range is our confirmation that the trend is positive, and we can add to that position. We get that break a couple of days later, we get that break. This is a clear open end break above the 20, above all the moving averages. We can add to our position here. Add, and we don't get out of that trade until we start losing respect for the 8. We bounce, but we don't lose respect. We don't lose respect, don't lose respect, and we get this massive push off. Now that massive push off, this can be seen as a sign of exhaustion, because we also form a top area here, and the price action, the buyers and the sellers aren't allowing the buyers to get above, what level is that? 122.86. So that will be a great opportunity to get out of that trade. Noticing that the price action isn't going above this level, get out of that trade, close out. We're also kind of extended from our 8-period moving average. So that's another opportunity to get out of that trade and profit off that third move. So we've done this first move, second move, and now we've done the third move in Apple. And that's all from August, just reading the price action and trading accordingly. So now we're sitting at, what's this, October 12th now. We got our topping action, 13th topping action. What we're looking for now, we're looking for an inside bar or a range breakout, and we're going to trade in the direction of that breakout. So this is our range bar now. Put that up there. We got a couple of inside bars showing indecision. We don't make a move yet, and then we get our break to the downside. That's not a strong break, but it is a break. And then we get the confirmation. So that's where you go short. And now you ride that move until you start losing respect for the 8-period moving average. We're starting to lose respect for it now. We've got this right here, looks like a bottom to me. This was, I want to say yesterday. This was, yes, November 2nd. And now we've got an inside bar today. So what I would do is I would write, this is my range now. This bottom bar is my range now. And if I get a break above this range, a good break above that range tomorrow, that's a opportunity to go long. Well, once I get that break, if it's a strong break, go long. If it's not as strong, you want to wait for the confirmation. Let's say we get this much of a break tomorrow. that may not be enough to go long. I would need confirmation, which would be Thursday. If I get this on Thursday, then we go long. You always want to wait for confirmation when you get your breakouts if the breakout isn't a strong breakout. A strong breakout is usually confirmation in itself of the trend. But that is how you would trade, Apple, just utilizing the breakout zones of the bars. These are the breakout areas. These are the locations where the trend is reversing. These are the locations where you can trade and take advantage of that reversal of the trend. And that is how you swing trade. So that's Apple. Let's go to another asset. Let's do Microsoft right quick. It's another heavily traded asset. Okay, we've got Microsoft, and we're gonna do the same thing with Microsoft. We're gonna find our range zones, these important range zones. Let's go back to the beginning of August. So let's do, sorry about that. Okay, so this is August here. This is the August 3rd. So let's utilize August 3rd as our first range. That is a massive bar. Utilize that as our range. Now what we're looking for is a breakout. That's a very big range. That range is from 203.17 to 213. So that's a $10 range. A $10 range is a lot. That is a lot. So what I would still do though, you would wait for a break out of that range or a bounce off of the range. So let's look at our price action. What we get, we get an initial move up to the top of the range, but we don't break out of it. That's kind of bullish. I mean, that's a bearish signal. Let me go ahead and write this off. We bounced off of our range there. We couldn't break out, so that is bearish, short-term bearish move. And we're sitting at what, 210, 29, 211 range. That can be a short-term bear trade there also for a few days, because we couldn't break. We hit that range 4 days straight, 5 days straight, and couldn't break out of it. That's a short-term bearish move. So I won't be mad at you for going against this and taking that short, what's that, 2 days trade. That's a possible trade, especially once you get that red, that big red bar. I won't be mad at you for taking that trade. Now we can cut this in half. This is 50% retracement from that first day. We took it up, 50% again. Yeah, then we have the inside bar. So that's a good trade. You can take that trade. Just make sure you get out as soon as you stop losing, as soon as you stop declining, you get out of that trade quick. So that's a quick swing trade. Now, off of that, once you get that big bar and we get our inside bar, this here now becomes our range. So this is our next most recent elephant bar, and we've got this inside range. So now we know that something's happening. We don't know which side we're going to break out, to the upside or downside yet. We're above the 20-period moving average. We're bumping up against the 13, but we're still below the 8. So don't put on your trade yet. We're still inside. We're still inside. We're still inside. We're still inside. We are trending up. And as you can see, this is still our range. This is the biggest bar in this area. We haven't taken it out yet. And we don't take it out until here. What day is that? That is... We don't take out that range until the 20th of April. So the 20th of April is where you could have put went on a long trade, swing trade on Microsoft here. So that's our trade there. This is our stop. Our stop is up under that bar, and we put on that trade and we hold that trade until we stop losing respect for our moving average, the 8-period moving average. So you're gaining, you're in your trade. These are big, massive bars. These opportunities where you touch the bar, you touch the moving average, but you don't break it. That's a great opportunity to add more to your position. Take advantage of these massive bars here. Now we get an inside bar. You can utilize these locations as your ranges. When you get a big move and then you get an inside bar, that now becomes your new range. You know, the range is just a block of time, a day of a very important price movement, usually caused by institutional traders, up or down. Those are very important ranges to remember. Breaks above or below that range usually precede big moves. So we get our inside ranges and we break out to the top briefly. Um, that's not a time to add to that position because we're already extended from the 8 period moving average. We got this space. It's a lot of space here. And when there's space between a stock and the moving averages, it's always going to collapse back to the moving average eventually. So this would have been a time to get out of this trade. So we went from, let's see here, we started our trade at about 211 and we took that to about 229. That would have been a nice option trade there. And once we get out of that trade, you're out. What you're looking for now, let me get rid of some of this stuff. Like this. So now, once we get out of this trade, our next range is gonna be, we can utilize that as our range now. We initially get a massive break through that range. Now, I told you a weak break, you need to wait for follow through. A strong break, that strong break is your follow through. And we bust through the 8 period moving average. So now what we do is we go short. This is your shorting opportunity. And we go short, we profit off that. We stay into this trade until we stop losing respect for our moving averages. What's of note is this topping could have been seen as a double bottom. Usually there's a bounce off of a double bottom. You don't know how strong it's going to be, but there's usually a bounce off of the double bottom. So you wouldn't have been wrong for, selling some of your position here, a couple of your options. And then once you bounce off of the 8 period moving average here, you can add to that position again. And you want to go hold it till this is our next bottom area here. And we bounce off that into the 8. You start losing respect, you want to get out of your trade. So we got in here at the 225 range and we sold out in the 199 range. Okay, and after that you're out of the trade. Now you get this massive bar out of that range. This is your range now, remember, this is your range. And the very next day you get a massive push out of that range. Once again, I won't be mad at you for going long there, as long as you set, this bottom as your stop. And at that point, you probably would have got stopped out. You went in so long, so quick. Although you got, a good follow through, good breakout of your range. Sometimes it's not going to work 100%. And this time, hopefully, you would have got stopped out of some of your contracts. You don't have to stop out of the entire position, but pare back some if this move here breaks your stop. And if you're using the bar stop, that will break that stop. So maybe you would have got stopped out on a couple of your contracts here. But if you didn't lose all of them, and added to the position once it broke out of that range here. So after that move there, this move became your range. This move became your new range since it broke out of this stop. You broke out of that stop, so that's your new range now. And what you're looking for is a breakout from this range now. Let me clean this up a little bit. Let's get this out. And we get our breakout from this range here. Good breakout. Go back long again. That's where you go long at. When you get stopped out of a trade, and then it goes back into the direction you need it, you can look to go back into that trade. You can look to do that. Your assumption was based on sound technicals. Even then, sometimes you will get stopped out, but a stop is there to save you, protect you. It protects you from losing a lot of money on a trade. It doesn't mean don't trade or don't you were wrong. It's just that at instance you were a little late or maybe a little early. After that brief stop out, you go back into the trade here because we got a nice forceful breakout, and we're now above our 8-period moving average. And then our next bar the next day is a massive push up. Now we'll continue to push up, we continue to push up, and we don't start losing respect for our 8 until we get here. Hopefully you would have gotten out here before you lost a lot of that profit. The thing is, when you're in these trades, you're able to see as the price action, as the buyers outweigh the sellers or the sellers outweigh the buyers. When you're in a trade, you're able to see that. You're able to see the amount of shares that are changing hands each day. You're able to see how many options are changing hands each day. You're able to see who's buying those options, the buyers or the sellers. You're able to see all of that. So you're able to see when some trends are about to start happening. And hopefully you saw that this was an exhaustion bar from this trend. It just ran out of steam and it's going to head back to the moving averages, which is what it did. So hopefully you got out here, here at the latest. And now what you're doing is you're looking for a breakout out of this range. So that's your important range bar now. You don't get your next break until here. You break the range here. We're above the moving averages. You can go long again. So go long here. This is another opportunity. And we profit off that opportunity until we lose respect for the moving averages or we're far extended like we are here. And there we go. We move back into the 8-period moving average. We're out of our trade now. We're out of the trade. If you're in the trade here and you get this inside bar and another inside bar, you might want to get out of that trade because you've lost 50% of this bar already. A 50% retracement is fine. Usually you can come back from that. This here is a lot more than a 50% retracement. This is your move. You retrace 50% here. Now this is more like 70% retracement. That's probably not going to go back to the upside 100% like you need it. So get out of that trade and look for a break out of this range. We get the break out of this range here. It's not a strong break, so we want to wait for confirmation. Then we get another weak break out of that range. You can attack that because you're continuing that down range. So go short here. And you want to stay in that trade for as long as you're respecting the moving averages. We bump into it, but we don't break it. Bump into it, we don't break it. Bump into it, we don't break it, and we get a nice break to the downside. So after seeing this bar here, you got your inside bar to start November. This is November 2nd. This is November 3rd. So now's the time to get out of that trade now. This is your bottom area. And now this is our new range. So tomorrow, if we get a break above that range and it's a forceful break, that will be a new opportunity to go long on another swing trade for Apple. I know it's a little convoluted here now, but that's how you want to play your ranges to find swing trade opportunities. Let me clean it up just a little bit and just give you the ranges. You're just looking for important ranges based on these elephant bars and reversal patterns, these locations here where the trend is changing. That's what you're looking for. You want to attack those trend changes. You want to profit from that direction of that upcoming trend. That is how you swing trade. Any asset. All assets, follow the same relationship with their moving averages. They move away from the moving average, then they move back to it. They move away from the moving average, and then they move right back into it. Away from the moving average, right back to it. That's the perpetual cycle of every traded asset in the world. So yeah, hope you've gained something from these two charts we just looked at, Microsoft and Apple, and how to utilize the moving averages to find swing trade opportunities in these guys. Thank you guys for watching, and I will see you all the next time. Thanks.